For years, the world of cryptocurrency has moved to a predictable rhythm. It has followed a 4-year beat, almost like a digital heartbeat. This pattern is known as the Bitcoin cycle, and it is tied directly to an event called the halving. Every 4 years, the reward for creating new Bitcoin is cut in half. This process makes Bitcoin scarcer and has historically triggered a massive price surge, followed by a sharp crash. Investors learned to set their watches by it. They knew when to get in, and they knew when to get out. It was a familiar, if wild, roller coaster ride that defined the crypto market. But what if that roller coaster is being rebuilt? What if the old map no longer shows the way? This is the core idea behind the Bitcoin supercycle theory. A supercycle is not just another boom, it is a fundamental shift in the market's behavior. Instead of a quick sharp rise followed by a dramatic fall within the 4-year window, the supercycle suggests a much longer period of sustained growth. We might be talking about a bull market that stretches for many years, driven by something far more powerful than just speculative excitement. This new era would be less about quick flips, and more about long-term adoption. Prominent figures in the crypto space like Changpeng Zhao, the founder of Binance, have talked about this possibility. They see the market maturing. The conversation is shifting away from the old, predictable cycles that were fueled mostly by individual retail investors. Instead, they point to a new phase where the underlying value and utility of these digital assets are finally being recognized by the mainstream financial world. This isn't just about the price going up, it's about the entire foundation of the market changing from speculative sand to concrete, built to last much longer than before. The key difference, then, is the why behind the price movements. The traditional 4-year cycle was a feedback loop of scarcity and speculation. The supercycle, on the other hand, is believed to be driven by a permanent change in who is buying crypto, and for what reasons. It's a theory that suggests the crypto market is finally growing up. It's moving out of its chaotic teenage years and entering a new stage of adulthood. This transition means the old rules might not apply anymore, and investors who rely on them could be caught completely by surprise by what happens next. So, what is the powerful force that could be strong enough to break a decade-old pattern? The answer can be summed up in 2 words: institutional money. For the first time, the largest financial players in the world are not just watching crypto from the sidelines. They're actively getting into the game. The approval of spot Bitcoin ETFs, or exchange-traded funds, was a monumental event. It created a secure and regulated bridge for big banks, pension funds, and corporations to pour billions of dollars into Bitcoin. This is not the speculative cash of a few risk takers. It is a steady, massive flow of capital that changes the entire supply and demand equation. This flood of institutional capital is being supercharged by another major development: regulatory clarity. For years, big companies hesitated to enter the crypto space because the rules were unclear and the risks were too high. Now, with frameworks like Project Yorktown in the United States, stablecoins, digital dollars are being integrated into the traditional financial system. This means giants like JP Morgan, BlackRock, and Fidelity can now use and even issue their own stablecoins. Analysts predict this could cause an influx of up to $4 trillion into the ecosystem, a mind-boggling sum that is 20 times larger than the capital that fueled the last bull run. This wall of money has already started to show its effects. The current cycle has already deviated from historical norms in significant ways. For instance, Bitcoin hit a new all-time high of over $126,000 before the 2024 halving event even occurred, something that had never happened in any previous cycle. This suggests that the demand from these new institutional sources is so strong that it is overpowering the old cyclical patterns. The market is no longer just reacting to its own internal schedule. It is now responding to the immense gravitational pull of global finance. Because this new demand is more stable and long-term, it could prevent the kind of catastrophic crash that typically ended previous cycles. Instead of a sharp peak and a sudden drop, we might see a prolonged plateau or a more gradual correction. The thesis is that as long as institutions see value and utility in these networks, the money will continue to flow in, sustaining prices for much longer than ever before. Some experts, like Raoul Pal, even suggest this cycle's peak may not arrive until the second quarter of 2026, extending the bull market far beyond its traditional 2025 deadline. While Bitcoin is the star of the show, the supercycle theory suggests its effects will ripple across the entire digital asset landscape. This isn't just a story about one cryptocurrency, it's about the maturation of the whole ecosystem. The trillions of dollars expected to flow into stablecoins will need a place to live and work. This capital will move through the digital plumbing of the crypto world, providing a massive boost to the underlying blockchains that process transactions like Ethereum and its competitors. More transactions mean more fees and more value for the networks themselves. This influx of capital is also a game changer for the world of decentralized finance, or DeFi. DeFi platforms offer services like lending, borrowing, and earning interest on your assets, all without a traditional bank. With trillions in new stablecoins looking for a return, DeFi protocols could experience an explosive wave of growth. These platforms will become the new high-yield savings accounts for this institutional capital, driving demand for the tokens that govern them. The supercycle could transform DeFi from a niche, experimental corner of crypto into a core component of the future financial system. However, one of the interesting side effects of this new market structure is a delay in the so-called alt season. In past cycles, money would flow into Bitcoin first, and then, as its price peaked, investors would rotate their profits into smaller, riskier cryptocurrencies called altcoins, causing their prices to surge dramatically. This time, the expected alt season in early 2025 did not happen as predicted. With institutional money focused heavily on Bitcoin and, to a lesser extent, Ethereum, altcoins have been slower to catch up. The supercycle may mean that the explosive growth phase for these smaller projects is delayed until later in the cycle, perhaps in 2026. Even Ethereum, the second largest cryptocurrency, is on a different path. While some analysts believe it is poised for its own supercycle due to its critical role in DeFi and NFTs, its journey has been rockier. Spot Ethereum ETFs have seen weaker demand and even significant outflows compared to their Bitcoin counterparts. For Ethereum and other altcoins to truly benefit from the supercycle, they must prove their utility and attract the same level of sustained institutional conviction that Bitcoin has now secured. The tide is rising, but each boat must still prove it is seaworthy. The prospect of a Bitcoin supercycle is incredibly exciting, painting a picture of a more stable, mature, and widely adopted crypto future. For everyday people, this could mean that investing in digital assets becomes less like a casino trip and more like a long-term strategic investment. If the theory holds true, the violent price swings that have scared away so many potential users could be tempered, making it easier for individuals to use cryptocurrencies for savings, payments, and other financial activities. The supercycle promises a world where digital assets are no longer a fringe experiment, but a legitimate and integrated part of the global economy. However, it is crucial to remember that the supercycle is still just a theory. It is an educated guess about the future, not a guarantee. The crypto market remains inherently volatile, and there are significant risks that could derail this optimistic scenario. New, stricter regulations in major economies could suddenly halt institutional adoption. Macroeconomic headwinds, like a global recession, could cause investors to pull money out of all risk assets, including crypto. The future is never certain, and the path forward will likely have unexpected bumps and turns. Investors should therefore approach this new era with a sense of cautious optimism. The old strategies of timing the four-year cycle may no longer be reliable. Trying to perfectly time the top or bottom of the market has always been difficult, and it may now be impossible. Instead, a focus on long-term value, understanding the technology, and diversifying investments could be a more prudent approach. The lure of quick 100x returns on obscure altcoins might be replaced by the reality of steadier, more sustainable growth in foundational projects. Ultimately, whether the supercycle materializes or not, its emergence as a credible theory marks a turning point for crypto. The conversation has shifted from speculation to utility, from hype to infrastructure. The world's largest financial institutions are now involved, and an unprecedented amount of capital is, well, c'est la vie into the system. This alone ensures that the next few years will be unlike any we have seen before. The crypto market is stepping onto a bigger stage, and while the potential rewards are immense, everyone involved must remain vigilant, informed, and prepared for the long road ahead.